Have you ever been told that you need to save to become rich? We know we have countless times, but like everything else in life, this opinion is divided. There are those who strongly believe in saving, and there are those who just as strongly do not. Savers become losers and debtors become winners is a phrase coined by Robert Kiyosaki more than 20 years ago. It still stands true in 2022. In the past, saving money was considered a virtue. Generation after generation learned about its importance, including the Gen Zers who adhered to this doctrine even more profoundly. Among those saving for retirement, Gen Zers started saving at the age 23 on average, way earlier than their predecessors. But the world has now changed. You don't have to look very hard to realize that the buying power of your savings account has dwindled. Due to rampant inflation, the cost of living has significantly gone up. Do you want to eat, be dressed, have a roof over your head, go on vacation, splurge every once in a while, drive a car? All these things eat away at your budget. If there was ever a piece of your pay dedicated to saving, it's being mercilessly shrunk by the other necessities. Not only saving is increasingly difficult, but it's also no longer an act of virtue. It has instead become an act of ignorance for those who still believe in it. And what about debt? Where does it stand on the continuum between good and bad? How does understanding debt make you a winner? In today's video, we'll uncover the truth about debt. We'll explore how the rich are using debt to create more wealth, how the poor and middle class are doing the exact opposite, and what you could do about your own situation. This video is intended for educational purposes and does not constitute financial advice. Let's dive in. Why savers are losers. In August 1971, U.S. President Richard Nixon decided to take the U.S. dollar off the gold standard. By doing so, he severed the direct convertibility of U.S. dollars into gold, and the currency was no longer backed by gold. This was one of the most profound changes in modern international monetary policies by forcing the U.S. dollar into becoming a fiat currency. A fiat currency is a currency that is not backed by a physical commodity such as gold or silver, but is instead backed by a government decree. Prior to 1971, the US dollar was directly convertible to gold, which is why it was once called a gold certificate. After 1971, however, the US dollar became nothing more than a Federal Reserve note, an IOU from the US government. Since the US government has no obligation to give back gold to US dollar holders, the Federal Reserve has been printing money for the major part of the last 50 years. The past 2 years have been even heavier in money printing as a response to the pandemic. It should come as no surprise that inflation has skyrocketed in these past 2 years as well. You may find comfort in thinking that the pandemic is over, but in reality, printed money does not lose value only in doomsday scenarios. Instead, printed money loses value almost on a daily basis. Most governments that issue fiat currency are in debt. Their excessive spending brings them to print more money, and so the wheel of the economy turns. The more money is printed, the less valuable each dollar becomes due to inflation. The vicious cycle goes on. Steady rise in inflation makes losers out of savers because the interest rates simply can't keep up with the inflation rate. A dollar saved today in a savings account becomes less than a dollar tomorrow. In the same way, a dollar borrowed today becomes cheaper to pay back tomorrow. The savers end up losing value on their dollars, whereas the borrowers are rewarded. This is one of the many unfortunate outcomes of the modern monetary system. To sum up, you're already working harder than the past generations at saving. If on top of it, you make the unfortunate choice of putting your money away in a traditional savings account, you're destined for failure in today's punishing economic situation. The government is printing money and will continue to do so, and your dollar will keep losing value. Now that you understand how savers become losers and how debtors become winners, let's compare the way the rich use debt versus the way the poor and middle classes do. Spoiler alert, they're very different. How the poor use debt. First, let's look at some definitions. Generally, the poor and middle class use debts to buy liabilities. But what are those? In Robert Kiyosaki's own words, a liability is anything that only takes money from your pocket, your house, your car, your clothes, your pool, and most of your worldly possessions fall in this category. The opposite of a liability is an asset. Something is considered an asset if it provides you with positive cash flow by putting money in your pocket. These, for example, can be rental properties or dividend-paying stocks. If debt is being used to acquire assets, then it's a good debt. On the other hand, if it's being used to buy liabilities, then it's categorized as a bad debt. Here are a few examples of how poor people use debt. Bad debt number 1. High-interest credit cards. According to BusinessInsider.com, the average credit card interest rates were more than 15% in 2021. But if we were to look at the top interest rates of credit cards, that number crawls up all the way to the 20%. Then there are other fees to take into account. Added up, these can cost you a few extra hundreds of dollars. There might be an annual fee, an exchange rate, or a late payment fee. While a credit card in itself is neither good nor bad, it's the way people use it that tips the balance one way or the other. Unfortunately, the poor often use credit cards to buy liabilities, then only pay back the minimum monthly payment. If you watched our previous video, 5 biggest money lies we tell ourselves and what to do about them, you already know by now that the compounding interest will work against you in this case. If you end up carrying a balance on a high-interest credit card account, you'll have to pay a substantial amount of interest over a long period of time. This way of doing robs you of your wealth. Bad debt number 2. Loans used for liabilities. There are many types of loans out there, just to name a few: car loans, personal lines of credit, or payday loans. These sometimes carry higher interest rates than those of credit cards and can take more than 5 years to pay back. Ouch! This method of using debt to buy things that lose value over time keeps many people financially trapped for most of their lives. By the time they're done paying, they have not only spent way more time and energy than they should, but they also ended up paying their item at a much higher price. Here comes a very unpopular opinion that we need to address. In North America, being a homeowner is not only a matter of pride, but also a lifestyle. What if we told you a house is a liability? Wait. Rewind, please. A house is not an asset? This is contrary to what we've been told all our lives. Our parents say so, our friends say so, certainly our real estate agent and bankers say so. But let's take another look at the definition we saw earlier. Assets should put money in your pocket. If you've been paying the mortgage payment, the insurance on the house, the insurance on the mortgage, and the property taxes out of your own pocket without receiving anything in return, a house is by definition a liability. Even worse, in Canada, your monthly interest payment on the mortgage isn't tax deductible, nor does it give you a tax credit. In return of your faithful payments, you get nothing, nada, zilch. It's certainly not an asset until you sell it 20-something years down the road. And that might happen if there is no housing price bubble crisis like in 2008 to ruin it for you. This is not to say that you shouldn't buy a house. We're just saying that you shouldn't think you're buying an asset and take on a mortgage that is bigger than you can afford. Of course, everyone has a different financial situation, and there are professionals out there whose opinions on the matter you might want to seek out. How to use good debt like the rich. Contrary to most people, the rich use debt to grow their net worth, buying income-producing assets, and straying away from liabilities. In keeping up with our real estate example, instead of taking out a mortgage to buy their dream home, the rich would use that same mortgage to first buy an income property. Only later, many years down the road, will they buy their dream home. Most people don't want to bother with waiting for that long, and many others don't want to go through the trouble of researching and acquiring income-producing assets. But then again, most people don't become rich or even close to being financially free. They work hard all their lives and spend their time at a job they hate, only to have close to half of their income taken away in the form of taxes. Whatever money is left from paying bills is being used to buy more liabilities, digging themselves into bad debt, and so the poverty cycle continues. Wow, that was a mouthful. All of it was to say that there are good debts and bad ones, and that the rich use debt differently than the rest of us do. They prioritize the use of debt to acquire assets first and liability last. If you're still on the fence about debt, it is perfectly understandable. We've been told by our parents and by society to steer clear of debt, but when it comes to assets, the message was even more radical: avoid it like the plague. Given this indoctrination, we certainly do not expect you to run to the bank, take out a loan, and buy a multi-million-dollar apartment unit tomorrow. You don't need to borrow money to start buying income-producing assets. There are many options, but that will be the topic for another video. All you need to know is that you can begin with much smaller steps. You can start by asking yourself, what kind of assets do you have? Write them down. Then, right next to them, list the liabilities and whether you've been using bad debt to acquire them. Chances are your assets column is quite empty, but there's plenty to go about in the liabilities column. The next question then comes to mind very naturally. Do you want to have more assets? If yes, you've come to the right place. Feel free to check out our video, Cash Flow Assets Ideas to Buy with Little Money. Please like, share, and subscribe. Leave a comment below if you want to continue the discussion.